Okay, let's see if we can finish up chapter 13 here. Okay, sometimes instead of paying their stockholders with cash, they pay them with additional stock. And they might pay them stock dividends instead of cash dividends if they're trying to conserve their cash. They still want to keep their stockholders happy, but they don't want to give them cash, so they'll give them additional stock. Or the other reason is sometimes they might do this to reduce the market price of their stock. And why would a company want to reduce the market price of their stock? Well, they want to issue more stock to raise capital, but because the stock price is so high right now, they're not able to sell what they need. And so basic supply and demand, here's the demand for their stock and here's the supply, and let's say it's selling at $350 a share and they're having trouble finding people to buy it. They put more shares of stock out there, they increase the supply, and that brings the price down. So there's a little flashback to econ for you. This also comes from retained earnings, just like the cash dividends did. It has no effect on total equity. Remember we said the stockholders' equity section had two sections. It had the paid-in capital and the retained earnings. And so really what we're doing is we're moving it from one group to the other, but the total stays the same. And it also has no effect on assets or liabilities. We have the same type of situation that we had with the cash dividend. We have a date of declaration. We have a date of record. Anybody on record as of that date will receive the stock dividend. And then instead of payment, we have the date of distribution when they actually distribute the additional shares of stock. Two types of dividends. We have a small stock dividend and a large stock dividend. And we'll talk about large ones on the next page. But a small stock dividend will be something less than a 20 to 25% dividend. I promise you're not going to see something that's going to be a 22%. You have to decide if it's large or small. That would really depend on the type of business and how many shares they have out there. But you're going to see like 5 or 10 or 40 or 50, so it'll be obvious. If it's a small stock dividend, we debit the account stock dividends at the market value. We credit common stock distributable, which is a liability, a temporary liability, distributable for the par value, and then the difference, as you probably guessed, goes to our old friend paid in capital in excess of par common stock. So that's what the journal entry looked like, and we'll kind of show you here too how that looks. To get the market share, you would just take the market price times I'm sure I show you that I do it the same way each time. I would take it like this, and you'll get the same one no matter what you get. The number of shares times the market price times the dividend percent. So it's a 10% stock dividend, it would be 10%. To get, that's what this whole number is. To get this one, you would take the number of shares outstanding times the par value times the dividend percent. That's what goes here for the par, and then the difference would go to paid in capital. So for a large stock dividend, this would be, again, if it's over that 20 or 25%. These are all done at par. We ignore the market value of the price. So on the date that said this would be, again, over 20 or 25%. So when they declare the stock dividend, we debit stock dividends. And this again would be at par. So this would be the number of shares times the par value times whatever percent dividend we're doing. And then we would credit common stock distributable for the same amount, that same par amount, and that's it. There's no, you can't have paid in capital on the large stock dividend. And then when they distribute it, this would be the same for the large or small. We're going to credit common stock distributable. That's what we're going to debit. We're going to credit common stock, and this again will be at par. So for instance, if we went back to the small stock dividend, this would be the amount that you would distribute right then. You won't see this amount again, and you won't see this amount again. This will be the amount that you put in here for the common stock distributable. And then there's a couple problems in the, I think there's 2 problems in the demo problems for you to work on that. A stock split. If we do a stock split, we will increase the number of shares outstanding, and we will decrease the par value per share. So for instance, let's say this is all the stock that's out there, okay? And here's all the shares outstanding, okay? And this is mine right here, okay? This is the part of the company that I own, this yellow part right here. So if they do, say, a 2-for-1 stock split, they end up splitting each one in 2. So now there are twice as many. So a 2-for-1 stock split. Take the number of shares times 2, and you would take the par value divided by 2. So you've got twice as many, but each one's worth half as much. So in this case, here's the yellow section I still have. If you look at this as a pie, I now have 2 pieces of pie, but each one is half the size it was before. So I don't have any more pie than I have. I have 2 smaller pieces instead of 1 bigger piece, but I have the same amount of pie as I had before. And that's exactly what happens with a stock split. So each stockholder still owns the same amount of stock that they had before. It's just the number of shares has changed. Again, a firm would do this if they're trying to bring the stock price down. The market price, again, they can't dictate the market price, but if there's twice as many shares out there, again, going back to supply and demand, we should see the price go down. But overall, the ownership hasn't changed. And there's no journal entry for these. They just kind of do a memo, just kind of explaining what they did. And then the only thing that changes, this is a problem in the demo problems, and these guys do a 2-for-1 stock split. So all that changes, these numbers right here all stay the same. And we take the par value in half, so it's 50-cent par value, and the number of shares outstanding doubles. So we have 220 million at $50 par. And so instead of 1 times 110, I have 220 times 50 cents, and so the total over here is the same. So there's no journal entry, and the words on the balance sheet will change, but other than that, it stays the same. And then the last type of thing we need to cover is treasury stock. This is when a company buys back its stock, and it can do this for a number of reasons. Maybe it's trying to hold the stock price up, so it wants to reduce the supply that's out there. Maybe they offered stock options to their employees, and they have to buy it back so that they can provide that. Or maybe they think the value is going to go up in the future, and so they buy it back now, and then they want to hold on to it and sell it later when the price goes up. So when they purchase treasury stock, that's what we call it. It's stuff that's been issued and outstanding, now we bought it back. So now it's still issued, you can't unissue it, but it's no longer outstanding. We do not pay dividends on treasury stock, the stuff that we brought back in. So I debit treasury stock, and I credit cash because I paid for it. It's like I'm going out there and buying it just like anybody else would. And this would be for whatever I paid for it. So this would be the kind of the market price. If I go back and sell that later, I would debit cash because I'm selling it for, I'll just put sale amount, whatever I sold it for. So let's say when I bought it back, I was paying $10 a share, okay? And now when I sold it for $12 a share. So I'll debit cash for the $12. I'll credit treasury stock at the cost, at what I paid for it. I can't take it out. I had to take it out of treasury stock for the same price I paid for it. And so that's here, and then if there's a difference, it goes to paid in capital. Paid in capital for treasury stock. Keep in mind, I could sell it for a loss, okay? So let's say I sold it, and here's cash, but I sold it for $7. So again, this would be the 7. Treasury stock would still come out for the 10. And so I need, this time it's still going to go to paid in capital, but I'm debiting paid in capital for the difference. So this would be when I sold it for a loss, it would look like this. If the loss was so great that whatever's sitting in paid in capital can't cover it, it would have to come out of retained earnings. So you've got a couple examples in the book like this. So these would be, so this one I would kind of sell it for a gain, and this one I would sell it for a loss, and so I'd have to debit paid in capital. And I'd pull as much as I can out of paid in capital, but if the loss doesn't cover that, I would pull it out of retained earnings. So that's what the treasury stock looks like. And there's some problems when you're buying and selling. You kind of just have to keep track, and you have to know when you take it out of treasury stock what you would have paid for it originally. So sometimes you might have to go back and look at an earlier part of the problem to figure out what you paid for it. And I think that's all I have on the treasury stock. Let's see. Again, I might purchase treasury stock to earn a profit, to increase my assets and gain cash there. I might want to hold up the stock price. I might just be buying it to avoid a takeover. I don't want other people to buy them. Let's see what else. Treasury stock is a contra equity account. Remember we had accumulated depreciation as a contra asset. Well, this is a contra equity. It kind of takes away from equity, and it is always recorded at cost. So those are some things to remember about treasury stock, and there's the basic journal entries. This is, again, your statement of retained earnings, which we have our starting retained earnings, plus what we added in for net income, minus any dividends that we paid out, will equal our ending balance. So just like the statement of owner's equity, this is kind of showing what went in and what went out. It's actually very similar to the statement of owner's equity. You've got your net income that you added, and the dividends are not that different than the withdrawals from the owners. And the last one, I don't think I have anything on the quiz, but I just kind of wanted to show you some of these common ratios that are used to measure stocks. So earnings per share is a very, very common one. You take the net income for the year minus any preferred stock dividends that were paid, and then divide that by the average number of shares of common stock. And remember, anytime you see average, that would be the beginning plus the ending divided by 2. So the number of shares at the beginning of the year plus the number of shares at the end of the year divided by 2. And pretty much any time in these ratios you see average, that's what you're going to do. The price earnings ratio is another big one that stockholders look at or potential investors look at. And so you would take the market price per share divided by the earnings per share, which is what we just figured out right here. And that's another big one that potential stockholders will look at to compare. And the last one you'll see there is rate of return on common stock. So it's that net income minus preferred stock dividends. So we take what they had minus what they paid the preferred guys. And we take whatever's left and we divide that by the average common stock equity. That'll be related to par. And again, that'll be, when we say average, we mean the beginning balance plus the ending balance divided by 2. And those are some very common ratios that you'll see that stockholders look like. So now that you know what some of these things are, you can kind of know what those ratios mean if you see those out there. Okay, that's chapter 13.